Okay. Buy these 5 stocks now. Our high-risk portfolio is now up 22% year to date, outperforming the S&P 500 7% return year to date by 214%. And we actually have one of our positions skyrocketing it up after we took these screenshots. We're up even higher. Our total return since 2021 is 290%, outperforming the S&P 500's 11.74% by 2,246%. Here's our current trade recommendation. Now, if you remember, you can log in and punch in total to invest. It'll automatically calculate how many shares to purchase. All members follow the same unit of investment, which is a ratio of shares. Currently, one unit is costing $1,920. You're picking up 20 shares of UVXY, the crash insurance, 49 shares of TMF, betting that the long end interest rates are going to fall, 49 shares of TMF. That's on the defensive side of the portfolio. On the offense, we have 9 shares of Coin for Coinbase. This puppy is up 16% right now. Next, we have 8 shares of FNGU. This is the big tech companies leverage times 3. You're getting big companies like Microsoft, Facebook, Tesla, and many more. If you want to be in on the AI revolution, that's the play for this. Meanwhile, we have a small commodity hedge in natural gas, 21 shares, ticker BOIL. We're going to be getting ready to add to BOIL and add another inflation hedge NRGU, but I think we got to wait quite a while. It might even be all the way till summer when the debt ceiling's lifted. If we look at our returns this year, we had a 14.6% total return for January and sitting on a 6.97% total return for 2023. Now, if you're a paid member, you have an opportunity to jump into our private equity company, which can replace your Coinbase or FNGU position with Rebel Dividends shares. This portfolio is up 59.29% year to date, and it dishes out a weekly dividend, and it gives you triple leverage on ETH, our favorite digital currency, which today is skyrocketing up 6.9% right now. Bitcoin's leading it, so get ready for a melt up coming. Call Dean now to get positioned at 505-322-7515. Okay, I've got some new hot slides, and then we'll jump into charts. So the CPI came in, and it was a little bit hot. It was not what we wanted, and the market's still going our favor. So wait till that CPI is crashing. Essentially, we have services. Anything related to services is still having rising inflation. And so this is the new probabilities for rate hikes, which I think are quite accurate. Essentially expected 25 basis point on March. So I'll take this from 4.5 to 4.75 on the federal funds rate. In May, we've now priced in a 74% probability of another 25 basis point hike. And now we're almost at a 50% odds of a one more hike, bringing the terminal rate towards 5.25, potential all the way up to 5.5. So there's a lot of rate hikes now priced into the bond market. My expectation is the inflation will be crashing by then, and that we have probably 2 more rate hikes ahead. Once that pause officially happens, look for the dollar index to fall and for digital currencies and tech stocks, as well as emerging market stocks, to skyrocket. Here's a big look at what's going on in the global economy with inflation. So we can see inflation's begun to fall globally, and that leading indicators like hard data and soft data have been crashing. But we've seen a recent bounce in the soft data and leading data. And this was further reinforced with the US's services inflation jumping this month. Very strong January retail sales printed today, 500,000 jobs added in December. And then furthermore, some of the countries that are leading the inflation fall, like Spain, had a tick up. Now, the data came in pretty weak in December and really hot in January. And there's a lot of seasonality adjustments. Overall, I think we have a good economy that's slowing down with Goldilocks conditions. Here's a look at the jump in retail sales in January going back up. And everybody thought without more stimulus checks, this economy was going to die. But we're still sitting on trillions of dollars of savings that was not yet withdrawn from balances. Now, this one is a third of the CPI. It's shelter, and it just hit a new high, the largest increase in 33 years. But this is like 12 months old. We know that rent has been falling for the last 6 months with housing prices. So a third of the CPI index is almost certainly going to be crashing for the rest of the year. So we can see this in the shelter CPI going straight up, but we saw a peak about a year ago. So we've got a good year of this part of the CPI to begin falling and really pushing down the CPI metrics. Now this is looking at a relationship between tech stocks and energy stocks, and it's basically pointing out where we look like we're at an inflection point where energy is going to be weak and tech stocks, especially digital currencies like ETH, are getting ready to rip higher due to interest rates falling and peak inflation being in place. So here's the big battle. In blue, you have one inflation metric stripping out services, and then in the orange, you have the services. And you can see those services hit a new high, 7.2%. But when you strip out the commodities, food, and energy, you can see the inflation's crashing. And I do believe we're on the verge of seeing services flatten and then follow the trend. Here's a breakdown of where we saw a lot of the inflation, and you can see it's really stuck in the energy services sector with these 20 to 25% prints. This is another look at core CPI inflation, and it's looking at output prices and supplier delivery times. And you can see, and this also coincides with shipping freights, Baltic Dry Index. A lot of good reasons to believe inflation is not just going to fall, it's getting ready to crash. Here's another look, and we can see we have overall in blue ticking up a little bit, core with private new rent indexes for shelter. That's using real rent indexes. The inflation will be way lower. And then we have the green and orange also showing a little bit of a tick up. This is looking at just the overall inflation data, and so it's just been on a non-stop ride higher. Expect for this to flatten out. I'm not expecting it to crash, but to slow down and flatten out. And that's what's going to make the rate of change of inflation head towards the target rate of 2. Now, we're also seeing personal savings rate tick up, which means they're going to be doing less spending. This is a trend we want to see to be essentially predicting a slowdown in the economy and lower inflation. This is looking at the average return on stocks from 1928 to 2021 during rising inflation, falling inflation, rising rates, and falling rates. And the best return possible on average is during a period of falling inflation, which is what we're anticipating for about the next 2.5 years. The consumer is running lots of credit, but it's not a lot of their household income. So we're seeing rising credit quite rapidly, but it's only at 5% of their net worth. So they're not even back to 2018 credit card utilization rate. So back 2018, the poorest group of credit borrowers were running 32% of their total credit available. Today, that's under 30%. And on the income earners over 125,000, it's really low at 24%. So in general, people's balance sheets are very healthy. This is looking at inflation all the way back to 1914. We've had spikes before, but I want you to note, once the spike tops out, it crashes hard to the downside. So we really like to be long the long end of the bond market in case we go into recession. If we're going to have this Goldilocks soft landing, which is what I'm anticipating at least for the next 12 months, you're going to make far more money in tech stocks and digital currencies. So that's how we're positioned aggressively in the high risk portfolio. Now remember, the last year was one of the worst returns for the 60-40 portfolio of all time. And we were saying, get ready, things are going to change. And sure enough, we're off to one of the best starts for the 60-40 portfolio year to date. ISM under 45 has always coincided with falling payrolls. This is one thing all the analysts have been off on. everybody's been predicting negative employment, and we just had a huge print of 500,000 jobs. Now, a lot of these jobs are people taking on multiple jobs, but overall, we're at record low unemployment with massive job openings. And there's just really no reason to think we're about to hit some sort of massive recession to crash markets. Instead, we've got Goldilocks conditions here. Now, here's the total net worth of the top 1%. And so I want you to note, during the financial crisis of 2008, look what happened to the value of their net worth. It really crashed leading into the recession. Today, their net worth is just shy of $45 trillion, and it's barely pulled back in value with an entire year sell-off and these massive rate hikes, the fastest in history. Now, the bottom 50% actually hasn't lost value at all, and you can see they're sitting at $4.5 trillion. So the bottom half has 1/10 the money of the uber rich. Now, if we look at that comparison back in the 2008 crash, the ratio was a lot better, about twice as good. So what do you know? The super wealthy continue to accumulate wealth. Another reason to be bullish on markets is companies are doing record stock buybacks. January authorizations for $131 billion. This is the biggest January authorization for stock buybacks in history, which is going to reduce the outstanding shares. This is looking at consumer credit and relative to assets, and you can see it's at low. The utilization of credit relative to income is below 6%, so very healthy on this front. This is looking at the M2 money supply relative to PPI, Producer Price Index, and the Consumer Price Index. It's essentially predicting a good year of falling inflation. Now, we do know that China, Japan have started to print money, that the US government has offset the US's quantitative tightening, and that there's $2 trillion in reverse repo that's ready to flood into the economy. So this could start to change to the upside. But for now, there's a very clear path to lower interest rates, lower inflation ahead. If stocks are down the previous year, this trifecta is very bullish. Trifecta of the Santa Claus rally, first 5 days of the year, and January all green, 1950 to current. 100% track record of having a huge return the next year. The average being 27%, with the highest return in 1954 pulling off a 45% gain. How has the S&P 500 performed once the Fed hits pause? And you can see 100% track record of great gains. Now, be careful. The dot-com bust had a pause where you got a 3-month rally of 11%, and then they had to keep hiking rates because the inflation was bad. And you ended up having a crash after that. Also, of course, after 2006, 2007, eventually the housing market collapsed and you got a crash. But it took a while after. So when they hit pause, that's usually a very bullish period. And we're not there yet. We could be 3, 4, 6 months out from the actual pause, depending on how the CPI looks in the next 2 months. Money market funds have almost $5 trillion sitting in dry powder to load into financial assets. As soon as it's more clear inflation's coming down and the Fed is going to pause. So there's just a lot of reasons to be very bullish right now. This is looking at the liquidity cycle. So we're at the bottom of a tightening cycle in liquidity and likely looking at a loosening all the way to 2025. So this is looking at bond market cycles and essentially predicting we're going to hit a low interest rate some point in 2025. That's when I think you're going to see your digital currencies like BTC break over $250,000 and perhaps ETHE get in the 12,000 to 20,000 range. And that's when we want to really take a lot of profits and get ready for a bust. Now, here's one of the reasons why you want to be long financial assets. The government wants to spend more money than they make. When you look at the breakdown, Social Security, health, income security, defense and veterans, Medicare, education, interest on debt, there's nobody who wants to reduce this. We've got the Republican House talking about being tough on this budget ahead of increasing the debt ceiling. I'll believe it when I see it. I'm expecting a massive deficit to run for quite some time. Now, also, the yield curve's the most inverted in like 50 years, which means there's a recession in the horizon. But typically that's going to be happening 12 to 2 years from the inversion bottoming, and it's going to be when the yield curve is steepening. So we're going to expect is the front end to fall and for the long end to either come down slower or rise. And that's what's going to make the yield curve steepen. And that also tends to happen as unemployment's rising. So until we see the yield curve steepening and unemployment rising, there's no reason to expect a recession or a stock market crash. In fact, Goldman Sachs is now only estimating a 25% odd of a recession in the next 12 months. Also, there's a gigantic record short position in treasuries. Ticker TMF will benefit the second that core services CPI is falling and the jobs gains are below 200,000 or negative. Oh, just watch for your treasury position to skyrocket to the upside. So in our safe growth strategy, we have a huge safe position in bonds. In our high risk, we're about just under a quarter of our portfolio on the long end of the bond market. So there's still about 1.2 trillion in excess savings. We saved up 2.2 trillion, and we've only drained about 1 trillion of that. And that doesn't even count the 5 trillion in the money market accounts. Okay, let's go through the charts and play by play. Buy 9 shares of coin, your ultimate growth play. This is up 25% in the past month and still has a lot of room to go. So just massive gains ahead for Coinbase, our favorite digital currency publicly traded company. I'm looking at Silvergate as a potential play. We may do a little trade alert on that soon, but right now Coinbase is just killing it for us. ETH, our favorite digital currency, up 4% in the last month, and a staggering 117,000% gain all time. That's even holding through the high of 4,500 and sitting on it right now at 1591 when we took this screenshot. But get this, just since we took that screenshot a couple hours ago, ETH has rocketed higher to 16,065. Okay, now again, main reason to be long digital currencies is a bet that governments are going to spend more money than they make. And the only way to pull this off is to print money and devalue their fiat currencies. And here's the trend. Try to spot out how many times the world has reduced global debt. There's like 3 total years in 50 where they actually were able to reduce it. So they're addicted like junkies, and it's happening at an accelerating pace. This is the US's own budget deficit projections, and they're undershooting it. Note that 2023 is probably going to run 1.3 to 1.6 trillion deficit when they forecasted only 1. They're expecting this to grow to 2, it'll probably grow to 3 by 2032. Here's the bond market cycle, which coincides with BTC, and they all line up perfectly. Also with the halving, which makes it more expensive to mine BTC. So I do think we will top 200K BTC by 2025, maybe 250 or even higher. When these things go parabolic, it just goes skyrocketing up. Okay, so don't miss out on your next trade alert. And if you want to get into Rebel Dividends, call Dean at 505-322-7515. Okay, BOIL, our inflation war hedge. Super warm weather really screwed up this play. Unfortunately, looks like you're going to make a lot of money, and this will be tested in 2023 winter. But I think it's bottoming out here and will slowly rise into winter. Plus, we have a major aggression about to unfold. I like being long natural gas and the big oil companies in the US with BOIL and NRGU. But we're looking at the timing of Europe and China to really be putting demand problems on supply, and I think that's going to lead more towards summer. And this will also be handy dandy when the debt ceiling's raised, probably in June. So we've been sitting on that drawdown in BOIL, patient to add to it. Expect us to add to that probably in the coming months leading into summer. Right now, we're just hanging on and looking for a truer bottom. So here's a picture of BOIL over the last month, down 44%, but it's been bottoming out since February and looks like it's stabilizing at these lower prices. NRGU, same idea. Even with the Chinese reopening, Russia cutting output, we got the US offsetting it by announcing more SPR releases. China is probably going to release some of its SPR. So I think we need to be a little more patient. I'm watching copper carefully. If copper breaks out, that'll be a good sign that China is really heating up. We want to get back long. For now, we're being patient on these plays. Here's a look at oil. Stabilizing over the last month, but overall it's been in a downtrend over the last year. It's down 6%, bottoming out, and slowly starting to rise back up. Crash insurance, UVXY, this takes a major decline in the S&P 500 to make money, and so far it's down 71% in the last year. We haven't touched this forever, but it can pay big. In the lockdown of 2020 in March, when stocks crashed 25% in a single month, UVXY screamed higher 1,000%. Okay, so I don't think now is the time to add to it, but we can slowly add to this where we think there might be a volatility event. Now, if I see a really bad inflation print coming out, this would get me more worried of more pain to come. But for now, quite confident the inflation will be on our side. Bonds, TMF down 9.8% in the last month. They bottomed in November and been bouncing around since then. They do not like all this strong economic data. The 500,000 jobs added in December, the rising core inflation, the strong wages, and the red hot retail sales have been pressuring the TLT down 3% in the last month. So it's surprising to see your long duration plays that hate when bonds are rising up so much in these conditions. Just shows you how strong the market is positioning itself to go all in on essentially interest rates falling and shooting tech stocks and digital currencies higher. Same picture in the investment grade bond market and the junk bond market. We're not playing those. Let's take a look at some of these shorter duration bonds. So on this, the higher this goes up, the less value the bond has. So we can see that 3-month treasury sitting at 4.77, which is where the next federal funds rate will probably jump to in early March. The 2-year making a new high, trading at 4.6. The 10-year jumping back up. So all these bond markets are just not liking this super strong economy. Now let's look at some of the inputs that were driving the inflation early on, like lumber futures. This has just crashed for the last year, down 64%. Copper futures, which had a bit of a rally with the China reopening news, have rolled over, and the last month they're down 4%. So without copper leading the way, it's hard to get super bullish on oil or gas. So we had a little fake out since July, ran it all the way up, and then it's really given up all those early January gains. Baltic Dry Index down 71%, the cost to ship commodities. This also aligns with container shipping costs from Shanghai. So the inflation seems to be pretty much done. We just have this lagging effect in the labor markets and services. Now, wheat futures have been jumping up 4% in the last month, but over the last year, flat. So all in all, quite confident we're going to see inflation fall and that our investors are perfectly positioned. Now, this is another thing. DXY at 103.9 is nuts to see a ETH rally in the face of a rising dollar. We're expecting over the next few years for DXY to bottom out in the 90 range. And that's when I'm expecting to see BTC priced at over $250,000. So to see this strength in equities and digital currencies with a rising dollar and falling oil is super impressive. Now in this chart, we're looking at a long-term picture of dollar index. And I want you to note, as the US debt has grown exponentially, the peak during a crisis of the value of the dollar against competing foreign currencies is getting lower over time. And I believe this trend will continue, unfortunately. The US is losing its superpower status slowly over time, and other countries are becoming more and more important in the world. And so if we look at the low in the 2008 to 2010 period, we were sub 80 DXY. if you're a big fan of digital currencies, note that BTC has made this massive return, being born in 2008, against the face of a rising dollar index. Okay, so it's gone from below 80 to above 100. The next big move could potentially take DXY back to those lows, if not lower. So I'm projecting a $250,000 BTC hitting a $90 DXY, which seems hard to fathom just with the price action and strength of the dollar we've had. But the long-term trend is clear. And if we do hit something like 70 or 80 on DXY, the potential price on BTC is far, far higher than a $250,000. Now, again, these big moves are taking 1 to 2 decades to play out. So a prediction of the DXY going towards 80 even or 70 is a decade or two out. And you could see some extreme prices in digital currencies over that period. There's big talks of Japan ending its yield curve control and unlimited bond buying. So we'll see if that plays out. For now, the yen has been under attack, as their bond market has, as they've been protecting their markets with massive money printing. And so they're betting that inflation is about to top, the Fed's going to pivot, and they can pull back all this support. And if so, their currency should strengthen and their bond market. China has had the same problem and the same, they're now starting to aggressively print with Japan, betting that the US is about to pause raising high rates. FNGU, the tech giants. Okay, so we've loaded up on this at the start of the year and it's performing beautifully for us. 64% gain in the last month after being down 59% in the last year, bottomed out in January and has been going straight up since. S&P 500 is up 3.76% in the last month, down 4.8% in the last year. The NASDAQ is up 9.6% in the last month and down 9% in the past year. Emerging markets is down 2.5% in the past month and down 17% in the last year. Starting off so strong in November with the whole reopening narrative. But with the interest rates rising, that's really the kryptonite for emerging markets. So they'll really outperform when the dollar's falling and the bond market's going up in the US. And that's part of our safe growth portfolio. No signs of a massive problem in Europe. Their stock market is flat over the last month and only down 5% in the last year. Some plays we may get into this summer. Uranium, URA, not in it currently. Rare earth metals, REMX, not in it currently. Some individual charts on Amazon, up 4% in the last month after a 33% pullback over the last year. Still a screaming deal. FNGU gives you exposure to all these companies. Apple up 14% in the last month, now only down 7% in the past year. Alibaba, which we get with EDC in our safe growth portfolio, is down 10% in the last month, 13% in the past year. Baidu up 16.5% in the last month and down 4% in the past year. Facebook ripping higher, up 30% in the past month and has recovered much of the 50% loss that it was posting to start off the year. Google up 6.3%. Their AI bot messed up in a demo and wiped out some massive amount of market cap, which seems a little bit silly. But Microsoft has all the hype now with their new AI search tool at Bing. So Microsoft's been doing very well, up 12% in the last month and only down 6% in the past year. Netflix ripping higher, 10%. And again, most of these are positions in FNGU, but you get it times 3, down 7% in the past year. NVIDIA up 30% in the last month, only down 3% in the past year now. Tesla leading the pack, up 63% in the past month, but still 25% over the last year negative. Some of the banks can be early signs of problems in the economy. A recession warning, up 2% in the last month, only down 5% in the past year. Bank of America up 2.8% and still cheap, down 22% over the past year. Taiwan Semiconductors, a position at EDC for our safe growth portfolio, up 3.9% in the past month, still a bargain at 22% drawdown over the last year. Okay, so we'll review this one more time. I don't think we're going to be making any changes for quite some time. As soon as we get a massive rally and have falling inflation, we're going to start to make some rotations to protect these gains and get a little heavier in commodities. And I think that timing is going to be closer to summer. So most likely there's be very few changes and let these positions rip higher. In the high risk strategy, we have 20 shares of UVXY, 49 shares of TMF, 9 shares of coin, 8 shares of FNGU, 21 shares of BOIL per unit of investment. We're up 22.5% year to date in the 2023 return. You can replace coin or FNGU with private equity at Rebel Dividends, which comes with a weekly dividend, and we're triple leveraged into ETH and some other coins related to that. Its year-to-date return is 59%. And you can call Dean now to learn more about that product at 505-322-7515. Okay, I'm going to take a look at questions. We got someone loading into BOIL. Yeah, I don't see a major catalyst. I think it's going to slowly go back up towards summer and is bottoming. I'm not expecting a big ripper on BOIL anytime soon, unless we get a massive cold front out of nowhere. John says, why is BOIL stalled? Warm weather is the single reason why, and less usage due to warm weather. Yeah, our Coinbase is killing it today, up 17% now. If you're in Rebel Dividends, you're making a ton of money today, as well as anyone in Coinbase, obviously. It does look like the Grayscale Trust is going to, well, it's Digital Currency Group owns much of Grayscale Trust. They've got a lawsuit with Gemini and Genesis, and it looks like they're coming to potentially a deal, which would be very good. Now, the higher the price of BTC and ETHE, the greater the valuation of Digital Currency Group and the greater revenue value of the Grayscale Trust. So all the economics are greatly improving in a bull market to solve that problem. Now our big fear is the SEC is going after stable coins related to Binance. So that's something to keep a close eye on. Looks like they are just killing off the competition. So Goldman Sachs, who owns Circle, has a monopoly here in the US. And so JP Morgan can also be a custodian replacing Silvergate. So like Gemini uses JP Morgan, but Binance was using Silvergate. Gold, I liked the digital currencies better than gold because we have to be competitive and have alpha and better returns than you can normally get. So if I was a central bank or a big government, sure, I'd like gold. But as a retail consumer investor, I'd far rather have Rebel Dividends or Coinbase or ETHE or GBTC. Okay, very good, guys. So we will be back on Tuesday with the Rebel Dividend webinar and Wednesday with the Portfolio Builder webinar. And I don't think we need to make many changes. So we're pretty much set to JET. At some point, we're going to add UVXY, BOIL, and NRGU and take some profits off of FNGU and coin. The bond position is back to where it started the year, so we're going to be patient for that one. But we have plenty of that in both portfolios. So yeah, just sit back and let these positions rip. We haven't even got the low inflation print that's going to be the catalyst to make these go up. So we're already getting these big gains I was talking about without the inflation doing what we want yet, or the jobs market, or the retail sales. So we're getting all the worst data possible and hitting some huge gains right now. Wait till the inflation turns a little sour. That's what's going to really rip these higher. So very good. Give Dean a call. Thank you guys so much. We'll check back with you with an update rest of the week. Monday, the banks are closed, and I believe the stock market's closed as well. So Rebel Dividends, we're going to ship out your dividend on Friday, so you hit that by Tuesday, Wednesday next week. Thank you guys so much, and we'll see you.